the Dash Trader Newsroom with an inflation update, market correction preparation as we come into the second or midway point of September, September 17th, 2021. My name is Michael DeJoy. I'm Director of Educational Services and licensed professional trader at Dash Trader. Joined with by my co-host, Jill Molandrino, Global Markets Reporter with NASDAQ. Jill, how are you?
Good, doing well, thank you. Good to see you.
Our favorite time of the week as the week comes to a close. I'll be heading down to the San Gennaro Festival after this. Haven't been there in a couple of years, so that should be
wow.
Yeah. I was surprised it was still going on, but it is. So
I know. I'm surprised. I haven't actually heard much buzz around it, to be honest, but that's great.
Heard nothing about it. Yep, but my friends were there yesterday, and they said good place to check out. So on that note, let's jump right into the news. We've got all kinds of market volatility that we haven't seen for quite some time. What are some of the root causes for additional market volatility? Obviously, we've talked quite a bit about September and October being traditional high volatility times for the market, but I'd love to hear your insights about what's going on and what's bringing on this kind of additional volatility as we get into the second week of September.
Well, Mike, there's a confluence of things that are happening. The labor market is certainly at the root of it. Consumer spend, that data is slowing down as well. Of course, we're coming to the Fed meeting next week, so interest rates and inflation are going to be top of mind. I think really another big part of it too are the issues that we're seeing with the supply chain. We simply can't get product in, and that is going to impact consumer behavior. It's going to impact the holiday shopping season. It's going to impact retail overall. So it's a couple of things. When you think about the employment market, you have a lack of labor and you have a lack of supply, and there's a lot of demand out there. So that has caused some economists to lower their GDP forecast. I don't think it's as volatile as we might historically think that September could be, but there definitely is a number of factors that do have participants kind of, not necessarily on the sidelines, but they certainly are a bit cautious. I think Q4 really is going to be a wild card. We are still in the thick of COVID. Hopefully we've peaked with the Delta variant, but there are certain parts of the country where it is still quite a concern. And we're getting into colder months here, certainly in the Northeast. So there's a number of variables out there, but I really think the employment issue and the supply chain issue are at the root of it.
Yeah, and certainly inflation as well. I think we've kind of honed in on the inflation in terms of food is mainly meat, pork, poultry, or any kind of meat, and specifically in food. And then also the other thing that's not generally factored into inflation. And I was just in LA, and I mean, housing prices have skyrocketed across the country. I mean, one of my friends in LA was moving back to New York because the increase in the apartments was so expensive, that it was I think a $400 increase in the lease renewal of a 2-bedroom apartment in LA, which is pretty significant. I mean, that was about $3,500, not even in center. So it seems like these housing and cost of living expenses are pretty pretty significant.
Yeah, Mike, it's interesting. I actually had an attorney from Romer DeVas on my show this afternoon. They handle housing transactions in New York City, and we were talking about how private equity groups such as Blackstone, for example, they're part of a $6 billion conglomerate that specifically swipes up residential homes. So for example, the commercial market got so weak because of COVID and companies pulling out of commercial contracts that they turned to the residential market. And what they're doing is homes that would have been attractive to first-time home buyers or buyers that might have been priced out of their market as a result of residential market just exploding with COVID-19, with people moving out of certain states to other states that could potentially have either better weather or better tax treatment, or the cost of living is so much more attractive in other areas in, let's say, the extreme coast. So not only are you competing with other people looking to own a home, you're also competing with private equity. And how do you compete with them with their treasure chest is full of billions of dollars?
Yeah, I mean, I had something like that. One of my uncles passed away in Texas, and basically the house sold above market price by like 50 or $60,000, and it was purchased by a private equity fund. And it was, I mean, well above list price of the house, which was really, really shocking. And I mean, it was very, good for this particular person, but at the same time, I mean, it wasn't something that was expected. And you hear that kind of story going on in lots of different places.
Right, and the other issue to that is a lot of the, once they purchase these homes, they will flip them back as either rent to buy, right? So you
Yeah,
can rent while you're saving for your down payment and so forth. And at first blush, that sounds good, but then it also makes the rental market go a little bit berserk too. So it really, the cost of living all around is quite a concern. And of course, when we talk about the labor shortage, part of that is also due to wages. People want to be compensated so that they can afford to live. And so we're kind of like stuck in this cycle here that seems like it's going to be a bit of a challenge to get out of.
definitely, definitely. And I would imagine the reason that these companies are doing rent to buy programs is because they want to make money on the sale price, but also the interest, while the person is paying all that massive interest. We all taken out mortgages in the past, and you see that when you buy a house, if you take out a mortgage, you're paying many times, many thousands and hundreds of thousands more just by paying the mortgage interest. And if you do default, it goes back to the bank anyway. So it's kind of an interesting paradigm shift, and it's driving up prices of housing around the country. So on that note, we have another interesting and kind of strange and surprising, little bit of news that's popped up over the course of the week. Now, I mean, I'm interested to find out and I think that this might be playing into some of the concerns of what's, going on in the stock market as well. Now, if I was a Fed governor and I was forced to sell my investments, or I've decided to sell my investments at these lofty prices, I wouldn't be so unhappy about it if I bought them during the onset of the pandemic, and as the Fed was starting some of their asset purchase programs, which I think is the problem. I mean, this is a very massive conflict of interest that Fed governors were investing in the very same stocks that the Federal Reserve is making investments in. And I mean, some of these are stocks, and some of these were more appropriately, I mean, more likely the bonds, the corporate bonds of some very well-known companies. And the one that really stood out to me was Apple. I mean, I think it was Apple. I'm not sure if it was Microsoft, but I definitely saw Apple's name among the list. So what's going on at the Fed? And to me, I know that, like, being a registered representative, I mean, you have very, very strict compliance. I'm sure you have very strict compliance as well, Jill, being at the NASDAQ. I mean, doesn't it surprise you a little bit that the Fed doesn't have this kind of strict compliance?
Well, I think
Monitoring.
right. I think it's more of a question of ethics versus doing something wrong. I think part of it is optics for sure. I mean, 2020 is a year where the central bank took emergency steps to prop up our markets and to prevent the economy from collapsing. And the trades, from what I have read, appear to be legal and in compliance with Fed rules, right? But I think it's just the mere possibility that Fed officials might be able to financially benefit from information that they learn through their positions. That's really what has prompted criticism of perceived shortcomings in the institution's ethical rules. So it's not as if the officials did something out of compliance. They acted within the Fed's, what they stipulate. But I just think it's because of the optics around the massive unprecedented stimulus that we've seen come out of the Fed, as well as the Treasury. And because of the information that they have, which is incredibly sensitive, that they certainly do get before it could hit the public markets or the tape, if you will. And I think that's what the question is. It's not that they did something wrong, but it's ethical standards that the Fed needs to review.
I mean, I mean, as a trader, or as a person who's traded for 23 years in finance, we have an old expression: don't fight the Fed, right? So, like, if you know the Fed is purchasing assets, you want to be long, right? As long as the Fed is doing some kind of asset purchase program, you want to be long the markets. Now, I have zero inside information and zero knowledge of what the Fed is actually purchasing. But I mean, these guys are actually Fed board governors. And, obviously they are following the rules if that is the case. If it's certainly the optics of the situation seems to be fairly negative, especially with people really, scrutinizing the Fed's activity as these buyback programs and the tapering of the buyback programs is kind of being played out here.
Yeah, well, from what I understand, the Fed bankers, they can't actively buy and sell most stocks or bonds that they with banks that they're supervising, right? So they can't own and trade the securities of supervised banks because of their pivotal role in bank oversight. But that's as far as it appears to extend. I know the Dallas Fed president, Rosengren, was the one that came under most scrutiny, and since then, he has worked, he has stayed within Fed compliance, but he's now, what did he say? He's going to sell the stocks. I'm sorry, the Federal Reserve Bank of Boston, not Dallas. I'm sorry. He's going to sell the individual stocks that he's in and move by September 30th and move financial holdings into passive investments, which for the most part is industry standard. For example, we don't have restrictions on ETFs or anything that's passive, but we can't buy and sell individual stocks. We have to hold them for at least 30 days. There's a whole number of things that those of us that work in the industry have to adhere to. But I definitely think that the Fed is most likely going to review its ethics and probably tighten their standards.
Yeah, I think that would be a pretty good idea, but that was certainly, I think a lot of people watch what's going on with Fed governors and watch what's going on with key holders, key institutional holders. So it might also be playing into a little bit of the correction that we have going on here. So what are some of the effects that can happen if the U.S., so I'll just give a little bit of background about the U.S. debt ceiling. So it was back in 2019, that they gave a 2-year increase that allowed, there was a 2-year increase in the debt ceiling. And now we are pretty much running out of additional leeway. I believe that the actual federal government's cash on hand, the Treasury, will run out somewhere in October, I believe. I mean, that's what some of the estimates that I've heard. So what could happen to the market? What could happen to the federal government? What are some of the effects of a failure to increase the debt ceiling? I know that there was some talk I know Congress is coming back into session. So I believe that we're going to be hearing a lot about the debt ceiling conversation. What are some of the effects that a failure to increase the U.S. debt ceiling, what could that do to the markets as we come into September, into October, if this is not addressed?
Right. So, and I'm surprised that the market hasn't reacted to it more. Perhaps it's focused on other areas and looking a bit further out. But what's so challenging with the debt ceiling is it's political calculus is really what it is. And members in both parties are always reluctant to cast votes that could be seen as contributing to our massive national debt. It's a delicate balance between appearing fiscally responsible in the next election and really avoiding any economic upheaval. So as we know, during the Obama administration, certainly the Republicans, it was a constant battle, and we know that. And that's, it's not picking one side or the other, but the debt ceiling wars have always been waged. They were relatively silent as the debt limit hikes were passed under President Trump. Clearly, we have a Democratic administration now, so I'm sure there's definitely going to be pushback there. Meanwhile, they were open to raising hikes. Now, that said, we also went through an unprecedented time with COVID and the pandemic. So I think there really sort of was a pass there. But I think it's really more political calculus as far as Congress is concerned. But you're right, Mike, if we can't get this vote through, and the US has historically never defaulted on its debt, although we have come pretty close, which is really what the concern is. But The economy is fragile right now as we go through the pandemic recovery, and it can also impact workers and businesses. A lot of businesses rely on the government being open and paying its bills.
So I mean, this is this is what I got when I was talking to some traders. I was saying, okay, guys, we have the debt ceiling coming due, and I mean and this is why I don't think the market, kind of has reacted yet to it. Traders' general response was, oh, this always happens. They'll pass something, right? So it's kind of an assumed, they're going to figure something out. Well, something will be passed to kind of mitigate, or potentially not shut down the federal government. But in the past, when we have had debt ceiling, we have had federal government shutdowns in the past. And the political brinksmanship kind of does go right to the very end. And I mean, certainly I remember it, and I'm sure you remember it as well with other situations of federal shutdown. So do you think that we're going to get that far in terms of political brinksmanship? Because I mean, I've never seen the country quite so polarized as it is these days. And certainly there is a lot of political brinksmanship going on, which only escalates more political shenanigans.
Right, and I agree with you. It's a little bit depressing as this continues day by day, to be honest with you. But the issue is, and we as traders talk about this ad nauseum with interest rates and how historically low they are, in an extreme situation in which lawmakers can't reach an agreement by what they call the drop dead date. Lenders across the globe could demand higher interest payments from the US government, as we're seen as a financial risk, right? So it's like anything else. If you are a lender and you are lending money to higher risk borrowers, of course you're going to charge them more interest because you're taking on more risk. And that's how other lenders across the globe could perceive us. In fact, when we came close just a few years ago, our debt grading got downgraded, right?
Yep, I remember that. It's first time ever.
But the thing is, Mike, with interest rates, it's a domino effect. So if interest rates are getting demanded by global lenders, it's a domino effect forcing interest rates throughout the US economy. That's everything from mortgages to auto loans to rates on corporate debt. That could, in sympathy, make those jump as well. And what do we talk about all the time? Interest rates rising. So you're right. It is a domino effect, and it is quite concerning.
Yeah, so I mean, that's the, general, kind of what we could be, a little bit worried about going into September and October is, we know that this is going to be a battle, and markets generally don't like uncertainty. So what we could be seeing in the last week and a half is what we actually did see is the first time the market has significantly pulled back, for some time. It's not a tremendous, I would say it's not even at correction level yet. But certainly we do have the potential for a correction as we go into this kind of uncertain battle of political brinksmanship in the near future.
Right, and Mike, to your point, if you're thinking about sectors, it's not even just sectors. I think it's more about the financial system overall, because I think a JP Morgan economist commented on this. Business contracts, really large business contracts, often require parties to post collateral of non-defaulting assets, and Mike, what is that? Treasury bonds, right? So this impacts actual U.S. financial system, never mind what sectors in the market. So I think, we have to look even bigger picture than what's happening in the stock market. This is
that's a fantastic point. I mean, that's a fantastic point. I hadn't even realized, I hadn't even factored in that, yes, treasuries are the mainstay of collateralized assets. I mean, that's what you put down as an asset when you're trying to do a big business deal. And if the treasuries get even close to defaulting, that could really put a big, a fair bit of nervousness into the markets for sure. Well, thank you so much, Jill. I want to wish you a fantastic weekend. You made some great points today, and enjoy your weekend till the next time.
All right, sounds good. Take care, everyone.
Bye-bye. All right, everybody. Let me jump to the charts where we can take a look at some of the assets that we've been talking about. I'm just going to switch my screens here and bring up my DAS trader. I mean, we really did close at a pretty pivotal level. Okay, so here we are. Hopefully, we're seeing my dash trader up here on the screen. And I mean, I'm just bringing up my first chart, which is the S&P SPY. Okay, the SPY broke below its 50-period moving average on the daily. This is the first time that we've closed below the 50-period moving average since June of this year. So we have not had a break below the 50-period moving average since June. We did test the 50-period moving average in July. You know, the question will be whether or not we gap down, because in June we closed at the lows on a Friday, and then we gapped up the next day and then kind of took off. We did test the 50-period moving average in May as well, and then we continue to go higher. But as you can see here on this chart, if we do start to fall on the S&P, and I'm going to just put this in here. I'm going to mark it as red using some of my color coding capabilities here on Dash Trader. So if we do go to, I mean, the next level is 436 on the SPY. Okay. And then the next level down would be right here at 422. So, I mean, you know, we have a lot of room here. If there is some kind of correction that's going to start. So from the high, which is 454, you know, you take off about 50 points, right? Because it's, you know, 45 points. So, I mean, we would have to go down to about, you know, 400 even for us to be a 10% correction. So we do have a tremendous amount of distance before we get into correction territory. So let's see, correction territory would be right around here at the 406 level. That would be the support level that's right here and these two key support levels. So that would be a correction in the market, and that would pretty much cut off most of the gains since April and May. So that would pretty much take these gains off the table if we were to get into that correction level. That would be 10% down. A bear market, to get into bear market territory, which is also very far away, would be down here in this level of congestion here at around 468 would be these two key points down here. So, I mean, you're talking a significant way down. This is on the S&P. Let me jump real quick onto the first thing I'm going to do is I'm going to add on one of my pre-configured chart analysis screeners. I'm going to bring up. No, this is not the one I want. I'm going to bring up the MACD on here. Here we go. So this one has the MACD and the RSI. So I'm going to actually get rid of the RSI. So right up here, we have the RSI. We have the CCI, which is the Commodity Channel Index, and we have the MACD. So, you know, got a couple of nice indicators. You can see here that the MACD signal line has crossed. You can see that we've come from a downtrend on the RSI. And you can see here on the CCI that we've kind of gone from overbought to now oversold. Although, you know, oversold can become even more oversold, and overbought can get even more overbought, as we've seen was happening on the uptrend. But certainly we are definitely downtrending on the MACD. I'm just going to remove my RSI. RSI being the relative strength indicator. So let me just do chart area. I'm going to remove the area. So now we can just look at this with the CCI and the MACD. So if we were to look at the area that this yellow line here is called the point of control. That would put us at around 390. That's where the majority of the volume that makes up this current trend. So what technical analysts would say that if we do start to get profound or increased selling, we would move towards a reversion back to the point of control, which would be here at 390 potentially. And that kind of does line up into that 10%, by the time things do get down there, a lot of times, the technicals will change a little bit, and that around that key 400 number would be the area that you would really be mindful of for the, the end of a potential correction. So if you notice, when I cut out some of the data and some of the heavy volume from back here, the point of control moves up to around 415, which is this more recent support level. Okay. Now, what I want to point out is that we've had a very, very overbought run in the MACD, and overbought becomes even more overbought. But when I put on my trend line, okay, when I take this trend line here, you can see that is a very big divergence, that the MACD has been diverging. So as the market's been making new highs, the MACD signal line has not been making new highs, nor has the MACD histogram. Okay, so the MACD histogram and the MACD signal line have not been making new highs. And furthermore, we've had a divergence as well in the CCI, the new highs being made on the CCI. So even though the market's been making new highs, and I can just point that out here, so you can see the market's making new highs, but you can see that these trend lines are not making new highs. That's called a divergence. So that's on the S&P. Let's take a look at the QQQ, because I think it's even a little bit more evident on the QQQ. You can see that we made a high and then a failure to make a new high on the MACD. I'm just going to draw that for you. So here's the high and the failure to make a new high on the MACD. And then here is the new highs there. And then, of course, we're going to take one more look here. We can see that this is kind of a little diversion right there. So we've had two divergence between the indicators and the price charts, which is kind of indicating now we have not gotten below the 200, the 50 period moving average on this on the QQQ yet. We haven't gotten below the again, it was that key kind of May to June period of time, which was the last time they had gotten the QQQ or the tech heavy NASDAQ got below the 50 period moving average. Was the last time that happened was back in May, June. Okay, so we definitely have some key divergences on the S&P as well. Now, the one that looks like the weak man is the Dow Jones Industrial Average. So the Dow Jones Industrial Average, if you look here, we've already kind of passed, or we're at the point that we're passing the point of control. Price is below the 10. Here you can see that the simple 10 period moving average, simple 20 period moving average, and then simple 50 period moving average. So price is below all of its moving averages. And actually the MACD signal line is not just a divergence, but it's also gone negative, meaning below the zero line on the MACD histogram. Okay, so let's go into some other sectors. So here we have gold, right? So gold is not doing particularly well either, which is interesting. Gold just had a pretty significant, gap down. So certainly no safety in gold. GBTC, Bitcoin, right? This is the grayscale Bitcoin, ETF, which tracks the price of Bitcoin. That's done fairly well, hanging in here and kind of forming what we call a low base in technical analysis. So Bitcoin has kind of served a little bit as a hedge versus U.S. securities, et cetera. So certainly that has, is one place that seems to be holding up fairly well. The other one is ETHE, which is Ethereum. Ethereum here hanging in at around, this is ETHE. Ethereum also holding up fairly well at 33. So Ethereum and Bitcoin look to be, these are the ETFs that track Ethereum and Bitcoin. They seem to be holding up fairly well. Now let's take a look at USO, which is oil. Oil is at pretty much record highs. USO here at $50. $50. And then if you go to the longer term, so if you're going to hold oil, okay, you want to use USL, which is at $25.91. So we have kind of a very, very strong, and if you look here, the MACD is the green signal line is above the red signal line. This is pretty strong. I mean, it looks like that we're probably going to have a long-term increase in the price of oil. And that's traditionally what happens going into the winter seasons. So you would expect oil prices to increase going into winter. Home heating oil, everything, costs more. Is also the weakness in the dollar would also affect the price of oil being mainly denominated in dollars. So certainly oil, Bitcoin, GBTC, Ethereum, ETHA seem to be holding up fairly well. Now, I like to also take a look at some of a big basket of tech stocks, which is AAPL. Apple, I mean, this is leading the sell-off down. I mean, Apple crossed underneath its 50-period moving average. Again, the MACD has that same kind of divergence situation. Let's take a look at Microsoft MSFT. Microsoft coming off of its highs, not quite as bearish as Apple. Let's take a look at Amazon, AMZN. Amazon still holding up fairly well, still above its major moving averages for the most part, and still holding up fairly well. NFLX. Now, I will tell you that the key indexes like Netflix had a really tremendous run recently, so Netflix also holding up very well. If the key component stocks don't hold up well, then they will drag down the index. So like Apple makes up a good 15%, maybe more or less, 13 to 15% of the index, the NASDAQ 100 index. So if a big component stock starts to go down, then it will drag the actual index down as well. So always be mindful of that. So let's look at some of the traditional companies, a company like ExxonMobil, which is a big component of the Dow. Again, it's in a downtrend. The Dow is in a downtrend. ExxonMobil's in a downtrend. Let's look at GE. GE, sideways trend near the bottom of its range. Let's look at Ford. Holding up okay, but certainly not really exciting. Let's look at US Steel. US Steel breaking below its main support level in a downtrend underneath its moving averages, kind of done with its rally, for the proposed infrastructure bill. That was the infrastructure bill rally, and now it's coming off of that high. And certainly it's got repeated oversold indications that have done nothing to help the stock. And the trend is still down as far as the signal line goes on the MACD. So some interesting observations across the board as far as the technical analysis goes. Let me jump back, and hopefully you're learning how to use your indicators on your dash trader as we go through these technical reviews in the newsroom. So I'm going to share my main screen here and jump back to the main presentation. We have a couple of interesting announcements for you all. So first of all, our #1 best trader competition is starting once again. Registration for all of our fall intermediate trading competition is now open and runs through 10/3. Competition begins on 10/4. It runs for 20 days ending on October 29th. Visit onebesttrader.com for more information and to sign up. The prizes include up to 9 months of access to your Dash Trader Pro platform for free. The winner's name displayed on the NASDAQ market site tower in Times Square. We also have the #1 best trader competition webinar, FAQ webinar. I will be doing that on this Monday, September 20th at 4:15 for the live webinar session for all of your questions about the full competition. They will be answered then. The webinar is available for anybody who has not signed up yet for the competition. You can email us at info@onebesttrader.com for the link. Certainly hope to see you there this coming Monday. I will give you a nice overview of the competition and give you some pointers as well as the best way to approach the competition. Have some I've accumulated some really good pointers for anybody who is looking to join or considering joining. I welcome you to come. On that note, let's just stay up to date on all things Dash by signing up for our monthly newsletter. Simply fill out the form at the bottom of our webpage, dashtrader.com. Subscribe to our YouTube channel, Dash Trader TV, for the Dash Trader newsroom reminders. Follow us on all of our social media links. That's at LinkedIn, Twitter, Facebook, and Instagram. Everybody have a wonderful, wonderful weekend. Look forward to seeing you in a couple of weeks. And certainly anybody who has not signed up, I look forward to seeing you on Monday for our FAQ webinar. Have a great weekend, everybody. Ciao. Trade well.